Hello and welcome to Your Money, Your Call. I'm Francesco Destratus from Audmanet. Tonight, as always, we are answering your questions on shares. Our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Joining me on the panel tonight is Tim Kelley from the Montgomery Fund and Evan Lucas from IG. Welcome to the program, gentlemen.
Francesco.
Tim, how's your week been?
It's been good. It's been an exciting month one way or another. We've seen takeover offer for IINet, some problematic clinical trial results for Certex, and a lot of stocks that we take an interest in moving around quite a bit. But overall, it's been good.
Yeah, post the reporting season tends to go into a bit of a lull, but we've been...
there's been a bit more activity this time.
Been a bit more activity in the markets. So where do you think the markets might be going over the next couple of months?
Look,
always a great question, isn't it?
As always, enormously hard to tell. I mean, you can probably take a little bit of an indication from the fact that markets have been rising pretty strongly. I think the Australian market up 40% over 3 years. And in the short term, at least, you expect that to probably continue. Ultimately, valuation becomes a problem, and the market is expensive in our view at the moment. So we think there is a decline somewhere down the track. But as long as the market's rising, your short-term expectation is probably that continues, particularly with interest rates remaining low and a lot of investors struggling to get a decent return on cash, turning to the equity markets as an alternative.
So a lot of investors are positioning themselves for potentially another rate cut. A lot of analysts out there are saying there will be another rate cut. What are your thoughts on that?
Look, the market has certainly priced in a rate cut. That's very widely the expectation. I mean, I think you've probably got to accept that the people whose job it is to forecast that have probably got it right. My own view is that it's a little bit perplexed in a sense. We've got interest rates at record lows now. Consumer confidence, business confidence, investment activity is subdued, and there's I think that's what's feeding into an expectation that we should expect further rate cuts. But with interest rates, with a cash rate at a record low, clearly low interest rates or excessively high interest rates are not the problem. And it's not that clear to me that we should expect further reductions in interest rates to necessarily solve the problem if high interest rates aren't the cause. And as well as that, we've got concerns about risk building in housing, in risky assets being priced with regard to very low interest rates, which could cause problems down the track if that overvaluation starts to unwind quickly. So I'm a bit bemused. I think the experts are saying we're in for more rate cuts, but we're already at record lows.
Yeah, a bit of a confusing landscape. We had a boardroom full of financial planners a couple of weeks ago, and they're all saying our clients are just asking us where can we get yield. They seem to think there's some hidden asset class.
It's people that should know better.
Yes.
just look at the yield. That's how you value these things now.
Yes.
It's just on the
Institutional.
Let's kick off with an email from Anthony. What are your thoughts on New Farm after today?
Look, that last comment is certainly one we agree with. New Farm is not a stock that we've looked at, largely because the economics of the business have been really very weak for quite some number of years now. And without knowing the stock in detail, I presume that's a reflection of largely being in a commodity market where price is the only tool you've got, and cost reduction is effectively the only strategy you've got. And that there are periods of time when cost reductions will drive improvements in operating performance and profits, and you'll get growth in that way. But cost reduction is, if one
edge of the sword, isn't it really? Yes.
Succeeds, then others will soon follow, and that's what makes it hard to do earn really attractive returns in that sort of business. So for us, New Farm, not a great business. Maybe enjoying a good stretch at the moment, but over a long stretch of time, we wouldn't expect it to return.
Just interesting.
Question is about Myer. If you were to have bought, or the boys on the panel were to have bought Myer today, would they see it as a short-term, medium-term, or long-term hold?
Okay, thanks for your question. Tim, what do you think? Short term, medium term, long term, or just not be there?
To be honest, I'd think of it as not having been a very good decision if I bought it today. I mean, for us, department store retailers generally, and Myer in particular with its position, face some real issues in terms of consumer behaviour. And if you look at the demographic profile of department store customers, what you see is that our parents' generation are devoted Myer shoppers, and they were devoted DJ's shoppers. Our kids are not. They've got more choice. They're better informed. They're more demanding, and you've got this quite stark drop off in the customer profile. And as the older customers move on, there's really no one coming through to replace them. And if you look at department stores over a long stretch of time, what you see is they're losing share. They're losing their share of consumer spend, and in markets around the world that's resulted in consolidation. There's needed to be fewer and fewer department stores because there's a smaller and smaller market for them, and we can't see a good reason to expect that to change.
And you'd have to say the specialty stores are doing a much better job competing price-wise and from service point of view.
Specialty stores is where a lot of it's going.
Come back to, what's your question?
Sure. Well, they say variety is the spice of life. Now, I'm fortunate enough to own a few shares at the moment in different industries. I'd like to add a telco to my existing portfolio, and I've heard you discussing TPG and iiNet. Tell me, gentlemen, what are your thoughts about Spark New Zealand?
Oh, okay. Spark New Zealand. Well, variety is the spice of life, and your portfolio should have some diversity in it. So looking at different sectors is always a good thing. So, Tim, what are your thoughts on Spark?
Look, I
think it took a big hit today.
That's an intriguing question. It's one that I haven't had a good look at, but it's one that I have been meaning to have a good look at. So there's Spark and Chorus, I think are both interesting propositions in New Zealand. But as yet, I haven't done the work to be able to say very much about Spark. So I'll probably defer to Evan on
to
that.
Evan.
It's an interesting one.
Don't disagree with any of that. TPG is one that we have followed and we have held in the past, but at the current price, it's one that we regard as a little expensive. MTU is another one that has also done well and is becoming expensive. We continue to hold that one in the Montgomery fund. It's not at a price yet that would prompt us to sell, but it certainly is not as cheap as it was. And while we very much like the telco space, we're struggling to find businesses that are at a price that we would currently want to buy them in quantity.
TPG's been in our portfolio for some time, probably a little bit more optimistic. We're happy to keep holding the stock, and if it has a little bit of a pullback, which is hard to find one at the moment in these stocks, we're happy topping up on it.
Yeah.
But the growth in this area, I think, is in the internet service providers with the data, because we're seeing companies like Netflix come to Australia where people's download capacity is going to increase significantly.
The rate of data consumption is growing very, very dramatically, and something that's not appreciated is that there's actually still quite a bit of scope for more broadband internet connections in Australia. There's a way to go before that growth story is fully played out. And one area that may become interesting is if the TPG bid for iiNet fails for whatever reason. iiNet, I think, stands out as a pretty interesting long-term hold. And
you'd probably wait until that had happened, because the share price would fall a bit.
You would wait until that did happen, and I'm not saying it's likely to happen, but there are some shareholders who are indicating that they may vote against the scheme. And there is also a possibility that the ACCC may take issue with the combination. So there's a chance that iiNet may down the track become available as an independent.
Or alternatively, TPG could increase their bid, and it'd still be earnings accretive.
Absolutely. I think your expectation is probably that TPG will acquire iiNet, but it's by no means guaranteed.
Sure. Okay, let's move on to what's your preference in the aged care area?
Well, look, we're pretty much aligned with Evan on this one. The overall theme of ageing population is one that we like quite a lot. But the way in which we've sort of expressed that in our investments has also been in the healthcare providers rather than in the aged care. And the reason for that is that we we've looked at some of the aged care businesses in the context of of IPOs and tried to get our minds around them, and we found it actually really hard to properly understand the industry and the regulation and the way the regulation may change. And we found it quite hard to get to a level of confidence that we really understood the values and the future for these businesses, and that's really held us back from investing in any of them thus far. But that's certainly not to say that they aren't good investments, just that we haven't been able to properly get our heads around the issues that attach to them.
Okay. Now, time for a viewer email. We have Kurosh writing, my question is regarding the retail food group. The retail food group share price seems to be slowly coming down. Is RFG supposed to be a cheaper version of Domino's Pizza? Oh, that's an interesting parallel to draw. Tim, what are your thoughts on that?
Well, Domino's Pizza is an interesting case in point. It's, I mean, a great business, but from a valuation perspective, it sort of makes our head spin. Retail food group is, it is also a very solid business.
Had a great result in the recent reporting season, didn't it?
It did. It legged up massively on the back of it.
Yeah, I think that's right, but it needed to. And even taking account of what brokers are expecting the business to deliver in the years ahead, it really is another one where it might be a cheaper version of Domino's, but Domino's is so expensive that it needs to be a lot cheaper to represent good value, and we don't think it's there.
Evan, straight to a caller. We've got John calling from Mandurah. Hello, John.
Yeah, good day. How you going, fellas? I was just ringing up about Brambles and what their prospects are over the next 18 months with the dollar maybe coming back a bit. With the US dollar rising and our dollar maybe falling with some more interest rate cuts. And I just wanted to see what the outlook was. And the other thing was with the market over the next couple of months, there's a lot of dividends getting paid next month out, and that's probably going to find its way into the market somewhere, maybe with that other cut, maybe not next month, but in May. So, the market, do you think will hold its line and maybe push up a bit over the next couple of months?
Well, thanks for your question, John. And look, I think you're very observant. Yes, dividends coming into the market and potential for rate cut. Could see people looking more into the equity market. But your question on Brambles, look, you've highlighted a very salient point about the currency. But I think when you look at Brambles and you look at their operations and a lot of their earnings come out of the US and the US economy starting to tick over, I think there's some growth in their earnings over the next 2 years as well. But Tim, what are your thoughts on Brambles?
Yeah, look, John, I think your two questions are probably almost the same question, in that the outlook for Brambles is probably the outlook for the market. I mean, from our point of view, Brambles, very decent, solid business. It has reasonable economics, and as Francesco has said, there are some growth expectations for it. The share price has risen over the last couple of years from below $6 to over $11. And from our point of view, that has made it expensive, and it's not something that we would look to buy if we didn't already own it. Having said that, it's by no means alone in the current market in terms of looking expensive, and I think over the next 18 months, it probably is largely a question of interest rates continuing to push cash into solid companies like Brambles, and so while it looks expensive to us, I can't see any reason to think that that will change anytime soon, particularly if it's able to deliver on the growth expectations.
Just to sort of throw a question out to both of you two is, if we don't see a cut, what's going to happen to the ASX? Because most times at the moment, most people are pricing in the idea that we are going to get a rate cut, the yield trade is going to continue, and therefore the banks, telcos, healthcare are going to continue to trade on these ridiculously high multiples. What happens if we don't? Is that going to be the point to see the pullback?
I think it probably depends on the reasons that we don't, and I suspect that a lot of people would probably regard it as a deferral of a rate cut rather than the absence of an expected rate cut. If we did find ourselves in a position where the RBA was saying it looks like we might need to have interest rates a bit higher in the foreseeable future, then I think there's a lot of what's baked into the current market is that yield play, and at some stage that really has to come out. So if you see higher interest rates in the shorter term, I think that's a really interesting situation for the current market.
The reason I ask, if you have a look at what happened on March 3rd, clearly showed you that there's some hot money in the market, and when we didn't get another cut, which is, okay, it was only a 50-50 chance that we were going to get it. When we didn't get it, there was that immediate pullback. Now it's gone back up again, and as I said to you, the expectations that there is an almost certainty by May we'll have a 25 bip cut. What happens if it doesn't eventuate? And that's the catch.
I think you'll find it'll come down to what the commentary is.
Yep.
You know, why wasn't there a cut? I mean, like you say, they didn't cut in March. The market pulled back a little bit, but then sort of had a breather and off it went again. So I think it'll come down to what the commentary is. I don't think any expert out there, or so-called expert out there, is suggesting there's going to be a rate rise.
Yeah.
So I think, with the interest rate environment where it is, it's lowest it's been.
Didn't Eastlake come out with a completely out of consensus call the other day and say that rates will rise by the end of the year?
Yeah, he's maybe got to get his name in the paper sometimes.
But I think as an interesting context, you've now got, I think, UBS and Goldman both raising questions about the Australian banks and noting that at 32% of the market capitalisation of the ASX 300, the banking sector in Australia is a larger percentage of the market than in any developed market in history. And a lot of that value is exposed to the property market, where we've seen low interest rates driving a surge in prices. And if the banks fall, then the market falls. There's no two ways about it. So I think that there is a bit of fragility. I don't think we're likely to see an about face on interest rate expectations, but if we did, there's certainly a lot of risk for investors in that.
Yeah,
just on that pullback point, though, Francesco, something that we see quite a bit with our clients is that when the market's been healthy, we hear a view that I just want to wait for a pullback before I dip the money in. When we do see a pullback, that view changes. They think, oh, the market's going down now. I'll just wait for it. Wait for it to be going up again. And I think it's hard to predict the way people might behave.
Okay, let's take another caller. We have Luke in Brisbane. Hello, Luke.
Yeah, g'day, Francesco. Just looking at the Australian dollar that's moved up the last few days, does that mean that we're going to have CSL going down? And where do we buy CSL if it does go down?
Look, that's a good question, Luke. And look, I think day-to-day movements in the currency are not going to impact upon CSL's earnings translation over a 6 to 12-month period. I think you'd have to see a continuous movement in the currency for that to have any major impact. But look, CSL, one of the best performers in our market for a very long time. Tim, what do you think?
Yeah, look, I'm probably not the right person to answer your question because for one thing, we're very reluctant to forecast short-term movements if we can avoid it. Our view on something like CSL is it's a wonderful quality business. We've owned it for as long as I can remember. It's a little bit expensive now, and if it were to come back at all, we would probably take an interest in acquiring more. But the way we think about CSL is that it's one of the best quality businesses on the Australian market. You will be well rewarded owning businesses like that for the long term. So we try not to think about them in terms of trading. We just think about the quality and whether we can own them at a sensible price.
Very rare. You said it's expensive, but it always seems to be expensive. It's very rare you see it cheap, is it?
And so for a really high quality business, it's not unusual to observe that they're always expensive. And a good principle is often if a business is very high quality and you expect it to remain very high quality for a long time into the future, just keep owning it because those returns on incremental capital will effectively ensure that you get a good investment experience.
Okay, let's go to an email. We have John writing in. Could the panel please give their opinion on Capital Health? Now, this is a healthcare stock that's probably new to everyone's radar. I think it's in the diagnostics area.
Yeah,
it's had some great growth in the
it's
share price.
diagnostic imaging. It's bigger than it was, but it's still relatively small at around 580 mil of market cap. We had a look at it when it was a bit smaller, and it looked expensive. It's now looking a lot more expensive. It's trading on 35 times forecast FY16 earnings, and so it's not one that we've studied closely because we don't think that we could make a valuation case stack up for it. But nothing wrong with the business. The economics have been improving over time, which is a great sign. Return on equity some years ago was below the cost of equity, but more recently it's gotten well above the cost of equity. The business has been growing strongly, and it's great. But for us, it's another one that just doesn't make sense from a valuation point of view.
I think, Tim, you'd hold a number of healthcare stocks in your portfolio.
We do.
We've talked about a few of them now. So which are the ones that you're holding at the moment?
CSL we hold at the moment. We hold Ramsay Healthcare. We hold ResMed. We hold Certex, which is an interesting situation at the moment. But with the exception of Certex, they're businesses that have done very well in terms of share price growth, and they're not cheap. You really need to take, I think, a pretty long-term view to be comfortable with them at the.
It's interesting, Brown Certex. They had a rather disappointing announcement a couple of weeks ago, and the share price halved.
They did.
But I understand a lot of fund managers are in there buying the stock on that announcement.
Well, we held Certex going into it. We lightened our position going into the announcement because while we expected that the clinical trial results would be good, we recognised that they may not. So we went into it, were surprised like everyone to see the share price fall. We're especially surprised by how much it fell, because our interpretation of the clinical trial results was that it was not as bad as the share price was indicating. And so we spent the day talking to oncologists, talking to the company and running the numbers, and by the end of the day we were certainly buying Certex shares. Since then the price has recovered somewhat. But it's still an interesting situation where we think that there is still the potential for Certex to demonstrate the efficacy it needs to find a market in first line. But not very much of that at all is being priced in at the moment. So there's you've certainly got downside risk, but it appears to be to us an asymmetric risk where the market is too pessimistic in its balancing of the upside and the downside.
Oh, yeah. Excellent. Well, that's all we have time for today. Thanks so much to our guests this evening, Tim Kelley from the Montgomery Fund and Evan Lucas from IG.